Hello and welcome to Portfolio Matters. In today's episode, I will be talking about Volmaggedon. Now, a few weeks ago in the weekly, we were discussing how tightening financial conditions tended to lead to financial crises. And I promised to cover the tequila crisis of 1984, which we did in the weekly, but I will also split out into a separate podcast and Volmaggedon. Now, the reality is there's so much going on in the markets at the moment that we don't really have space in the weekly to cover Volmaggedon, so I'm doing it now. So Volmaggedon was the dramatic failure of some retail ETFs linked to VIX. They were short VIX ETFs, which went from a value of 1.6 billion to bankrupt in a day. So, background, what is VIX? Well, VIX is the implied volatility of the S&P 500 as calculated from options prices. So, it's what the market expects the volatility of the S&P 500 to be. And you can measure that volatility over different time frames. So there's a VIX for tomorrow, there's a VIX for 1 month's time, and there's a VIX for a year's time. And they imply what the market expects volatility to be tomorrow, in a month's time, and in a year's time. And those can all be different. In fact, they always will be different generally. And you can trade in VIX using options and futures which are traded on the Chicago Board of Exchange. Okay, so some background. So in the aftermath of the great financial crisis, the S&P 500 had been rising steadily and VIX had been declining. So as the massive spike in uncertainty surrounding the great financial crisis slowly dissipated, so people became more comfortable about holding the S&P 500 and they expected volatility to decline. So we get to late 2017, early 2018, the market has been rising for a long time and the market is rather confident and complacent. And various retail products had been launched to take advantage of the steady decline in VIX. The largest of these was the VelocityShares Daily Inverse VIX Short-Term Note, ticker XIV. It had been launched to allow retail investors to participate in a trade that only hedge funds had really been able to do previously. So during 2017, the S&P had been rising very smoothly. Volatility was low. So volatility had been steadily declining from already actually quite low levels throughout the period 2016, 2017. And investors were betting that VIX would continue to fall. And so XIV had been doing very well. If you'd bought XIV in February 2016, then by July of that year, you would have pentupled your money as VIX continued to decline. And the reason you would have pentupled your money was because the VIX futures curve was in contango. Now, I have done separately a my worst trade on VXX, the iPath short-term VIX ETN, which I had a disastrous dalliance with. And in that video, which I'll include a link to, I discuss contango and backwardation. But the point you need to know about this short VIX strategy was every day you would be selling the forward VIX future and buying the short-term VIX future. in order to maintain your exposure to VIX around, let's say, a month ahead. So you would have been selling the 2-month VIX, you would have been buying the VIX for tomorrow, let's say. And so you would have been selling VIX expensive and you'd be buying it cheap. So every day that contango continued and VIX didn't spike, you would have been making substantial profits. So on this chart here, if you were selling the November VIX contract at 14 and buying back the late July contract about 10, every day on the roll, you're making about a 40% profit. So as long as VIX doesn't spike, short VIX strategy can be quite lucrative if the futures curve is in contango. But by January 2018, VIX was at very low levels. It was around 10. And any surprise could see it soar. Now, to give you a comparison, VIX is currently, as we speak today, on the 4th of May at 29.08, and in early 2018 it was at 10. So VIX then was at very low levels, and then suddenly on the 5th of February 2018 VIX spiked hard, and people who were short VIX were going to suffer. But that is not what caused the failure of the XIV note. The XIV had a fatal flaw. So XIV, which had 1.6 billion under management, sold futures to maintain its exposure. So it wanted to be roughly short $1.6 billion worth of VIX, a 1-to-1 ratio with its assets. But as VIX rose, it lost money and its assets shrank. So it then needed to reduce its exposure to VIX, which meant buying back VIX futures in the markets that it had previously sold. But buying back those VIX futures drove the price of VIX up. And so they ended up in a negative feedback loop where, as the price went up, their assets under management shrank, which means that meant they need to cut back on their short VIX exposure, and then buying back those VIX futures drove the price up further. You have a negative feedback loop. So over the course of the day, VIX spiked. It went from 12 a couple of days previously to 37. So in the course of 2 days, it had essentially trebled. And that bankrupted XIV, the VelocityShares daily inverse VIX short-term ETN. It went from assets of 1.9 billion the day before to 63 million at the close of that day. But then in accounting afterwards, they calculated that actually XIV was bankrupt. So what was the aftermath? Well, retail holders of XIV lost almost all their money. Credit Suisse, who were the sponsors of XIV, announced that it would close. And the VIX volatility that was partly caused by the failure of XIV and its need to buy VIX futures in the market, exacerbating the spike in VIX, appeared to exacerbate the downturn in the market over the following days. Presumably, a lot of people had lost a lot of money and then had to liquidate other assets to cover their losses. And VIX remained elevated for a period and became less liquid. So the bid-offer spreads widened. Short VIX retail products disappeared from the market for a few years, but Now they're back. Okay, so in conclusion, don't mess around with stuff you don't fully understand. XIV was badly designed. There's this negative feedback loop designed into it, which would cause catastrophic losses if VIX spiked. And I'm not sure either its sponsors or its purchasers really understood that. So a lesson is that Wall Street will sell you anything that it thinks you'll buy. They make money by selling you the product and earning management fees on it. It doesn't matter to them whether it makes or loses you money. So beware. And finally, beware crowded trades. So trades where total position size is in excess of liquidity. So then what happens is the crowd has forced the price of these assets up beyond fair value. And when they realize that and try to get out, they swamp liquidity, forcing the share price down sharply, much more quickly than it otherwise would, and to below fair value. Okay, that's it. Thank you for watching. Please can you press like and subscribe to the channel, and it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.